Okay, hello everybody. I'm David Fruchtman, the chair of Steptoe and Johnson's State and Local Tax Practice. It's a pleasure to have you with us. And it is my great pleasure to introduce Matt Frank to you. Matt Frank has been with us for about, better part of a year, 7-8 months at least, and is transfer pricing royalty. And it is a great privilege to have him with us. It's a great privilege to have him here. He's shaking his head no, but the answer is yes. So, Matt, I'm going to turn it over to you. I'm going to put my video and mic on silent for the most part, and thank everybody for joining us.
Thanks, David. We're going to start with a polling question to find out who our audience is. So right out of the gate, here's the first polling question. Audience demographic: I'm an external advisor. I have an in-house tax or finance role. I'm a government employee or other. And I'll give you 30 seconds or so. We'll see what the answer is. And the results are as shown on the slide. Well, that's good. It's a good mix. So transfer pricing. Let me start with a few words of introduction. If you joined David and me about 4 weeks ago, about 1/4 of this will be familiar to you. We're talking about transfer pricing. We've got about 40 slides in this presentation. They are text light, and we'll move through them pretty quickly, especially the first 6 or 8. Transfer pricing simply refers to the pricing of transactions between related parties. Typically, it's a corporate structure, a parent and a subsidiary, or brother-sister corporations, but it includes LLPs, partnerships, other pass-throughs, and frankly, any form of organization, even individuals, are within the scope. Transfer pricing, you sometimes hear used as a pejorative. People will say so-called transfer pricing, or say that companies are engaged in transfer pricing like it's a choice or a strategy. On this slide is an excerpt from a 2006 Daily Telegraph news story that gives a flavor for how the term is sometimes used in the press. It said, the IRS claimed enormous sums of back tax from the company after alleging it engaged in so-called transfer pricing, a practice designed to ensure a company's tax liability falls in countries where the tax regime is more favorable. And there are lots of other references like this. There's a story from an article in the New York Times years ago, which offered a definition of transfer pricing, describing it as, quote, the practice of false dealings among companies to hide profits and avoid income tax. There's a similar treatment in some scholarly works. There was an excellent law review article written by an IRS official who later became a judge, who described transfer pricing or stated that, quote, the most common tax avoidance technique is known as transfer pricing. But transfer pricing is none of those things. It's just the setting of prices for transactions. It's not a scheme or a tactic or a strategy. It's a commercial and tax imperative. It's a tax issue because tax authorities are empowered for tax purposes to adjust transfer prices to increase income, to reduce deductions, in either event, increasing tax liability. They can do this if they consider it necessary to achieve a clear reflection of income, or whatever the particular expression in the statute is. What's a clear reflection of income is very much in the eye of the beholder. It's important to understand that tax authorities don't have to show, they don't even have to allege that prices were set to avoid tax. Excuse me, yes. Transfer pricing adjustments are made on a no-fault basis. It doesn't matter that the taxpayer acted in good faith. Good faith is not part of the discussion. And this slide cites to a New Jersey tax regulation, which makes this point, saying that the absence of a tax avoidance motive is not a consideration. Tax savings themselves are usually not a consideration either, and I'll return to that point in a moment. Scope, very broad. Transfer pricing applies to all sorts of transactions: the provision of services, the transfer of tangible or intangible property, the issuance of financial instruments. And it can cover sales, licenses, leases, any form of exchange. It doesn't even have to be an exchange that's recognized or documented by the parties. If one party allows another to make use of property, like use of a trademark, or even just use of know-how, that can be a transaction for transfer pricing purposes and subject to an adjustment or an imputation of income by a tax authority. Transfer pricing activity is in the income tax space, but it applies to other taxes as well, types of taxes. Sales tax is the principal non-income tax area where you'll see transfer pricing enforcement. At the federal level, transfer pricing is recognized as the #1 tax risk faced by multinationals. The IRS and foreign tax authorities are all over this, make lots of tax transfer pricing adjustments. And I'll return now to a point I just made about how tax savings are not an element of transfer pricing. There's a program at the IRS that taxpayers can use when they're subject to conflicting transfer pricing demands by more than one country. So they may report their profits in such a way that splits the income or profits 50-50, let's say between the US and Japan. And if one tax authority seeks to adjust that to increase its share of the pie, the taxpayer can take those cases into this competent authority program and seek resolution, seek an agreement by which the two countries can agree how to split the pie so that only 100% and not more is subject to tax. Now, if you look at the inventory of these cases, and there are hundreds of cases in inventory, they're principally between U.S. and its major treaty partners, which are also high tax jurisdictions. If you look at the inventory over the last 10 or 12 years, 70 to 80% of those cases involve foreign-initiated adjustments by high tax countries like Japan, Canada, Germany, all of whom are arguing that the taxpayer set prices in a way that left too much income, too much profit in the United States. The United States is not a tax haven. It doesn't matter to these other countries whether the taxpayer saved any taxes by structuring its transactions, by pricing its transactions in the way it did. The tax authorities are only concerned about the amount of income and profit in their jurisdiction. And if they think they should have gotten more of the pie, they will make an adjustment accordingly. Transfer pricing is such a big issue, such a big risk, because the adjustments can be huge and they're easy to make. In many cases, and certainly at the federal level, there's a presumption of correctness if the tax authority makes a transfer pricing adjustment. And the burden is on the taxpayer to show that the adjustment was unreasonable. And this creates incentives which can be unhelpful. There's a quote on this slide from a revenue agent from a 1971 case, tax court case, American Terrazzo, that highlights the ease with which a tax authority can make an adjustment. It's a bit extreme, but it highlights it gives a flavor of what taxpayers are sometimes up against. The IRS agent in that case said, I can just sit back and say it appeared to me that 20% net profit on an operation such as this was reasonable. I figured if the taxpayer were willing to accept it, I thought we'd be getting away with a very good deal, and if not, he would prove otherwise. In terms of the amounts at stake, as I say, the dollars can be huge. There was a case just last November, a U.S. tax court case involving CocaCola. The issue there was the price charged by Coca-Cola US to certain foreign affiliates for use of the Coca-Cola trademark. The IRS said that the US charged too little for use of that trademark. There were 3 years in the litigation, 2007, 2008, 2009. But the issue impacts 10 or 12 years because Coca-Cola continued to use its pricing method for years extending beyond the years in litigation. And the company has disclosed that if the IRS wins on this issue, it faces a bill of tax and interest of about $12 billion and potentially billions more in penalties. So these can be big dollar cases. Let's focus now on what's happening at the state level. The issue has been around for decades. There was some press 10 years ago. Kara Griffith at Tax Notes wrote a number of articles about states ramping up their state-level transfer pricing enforcement. In 2014 and 2015, it got some more press. The MTC launched its arm's length adjustment service called ALAS, and the FTA, Federation of Tax Administrators, featured transfer pricing at their 2015 Minneapolis conference, talking about, again, the opportunities and concerning transfer pricing enforcement at the state level. But in the past 18 months, it's everywhere. Every publication has multiple articles about a wave of transfer pricing enforcement. North Carolina and Indiana are very much in the press because of their transfer pricing initiatives. And there are lots of stories about states hiring external advisors for training purposes and to help them identify and pursue transfer pricing targets of opportunity. Some of the press has suggested that this is due in part to revenue shortfalls, tax revenue shortfalls at the state level due to the COVID pandemic. But there was an interesting study released about 2 weeks ago by two people from Multi-State Associates that suggests that those revenue shortfalls have not materialized. In fact, tax revenues at the state levels have increased. But what's going to happen at the state level on transfer pricing enforcement is not going to depend on 1 year of tax revenues. So whether they experience a shortfall or have maintained the historic levels of revenue probably is not going to drive what we're going to see this year, next year, and into the future. That brings us to our next polling question. Question for the audience. I think all the recent attention on transfer pricing reflects, 1, a genuine phenomenon of what's happening in the states. 2, mostly the MTC and advisors trying to be relevant and or generate business. 3, both in about equal amounts. 4, I wasn't aware that there was a lot of attention, that the issue's gotten a lot of attention. Or 5, something else entirely. I'll give you about 30 seconds. And the answers are interesting, and they're pretty much, frankly, what I'd expect, a nice distribution. All right, so state transfer pricing focus is encouraged to some extent by revenue estimates that suggests that a lot of money is being left on the table for states. In the 2015 FTA panel discussion on state transfer pricing enforcement, they put out a figure of $20 billion that was being left on the table by states that could be collected through more rigorous transfer pricing enforcement. Now, the FTA did not put that number out as sort of a rigorous or reliable figure. It was just an extrapolation from some federal transfer pricing data. More recently, a couple advisors published an article that suggested in the Northeast states alone, there's about $2.7 billion a year of additional revenue available through transfer pricing enforcement. And last year, an economist who works for a number of the states was quoted as saying the states, quote, could double or triple tax collections from large multi-state corporate taxpayers through transfer pricing. The point for taxpayers is not whether this is right. I have my doubts. The point is that this is what the states are being told. So, spurred by this, perhaps, the MTC has taken steps to try to reinvigorate its transfer pricing efforts. It has launched the State Intercompany Transactions Advisory Service, which is the next generation ALAS.
Matt, there was as you're aware, a meeting of the MTC yesterday of this committee, the State Intercompany Transactions Advisory Service. And it was scheduled for 90 minutes. It lasted about 20 minutes. There were two principal areas of activity. The first, they approved their charter. And the charter is interesting. It was a pro forma approval, I would say. There was no vote against it, and probably not expected. But the charter is interesting because it does talk about the emphasis on exchange of information. And in discussing that, it talks about how the states will take reasonable measures, something to that effect, to make sure that everybody who receives the information represents that they are authorized by the state to receive that information. And it's very doubtful, it seems to me, that that is the right standard to be applied. The states are obligated to protect confidential information that taxpayers provide. And so when the MTC has its CITES committees together and its training exercises or information sharing in a more revenue-focused audit, for example, I don't think that it has to take reasonable measures to make sure that or the states have to take reasonable measures to make sure that confidential information is not shared. It needs to make sure that confidential information is shared only with the people, the states, who are authorized to receive that information. You can be sure that we and other tax practitioners will be watching the MTC very closely, and the states, to make sure that they comply with their information sharing agreements as statutorily enacted. And then the second aspect of the meeting, of yesterday's meeting, was to discuss the intercompany, the exchange of taxpayer information between the participants in CITES. There is an updated draft information sharing document that's been circulated. To this point, no state has executed that. But we'll be watching that very carefully as well. So the meeting itself, I would say, was unremarkable. And yet, I think you need to treat this as the smoke from a distant fire. You need to watch it. We need to be aware of it. And the states seem to be taking a bit of a pause. There was no great heat or light generated in yesterday's meeting. But this would be an opportunity for taxpayers to, without having a lot of pressure on them, take a look at their intercompany pricing, decide whether they've anything that they might want to fix before the MTC in the states move this into another gear. Matt, I'll turn it back to you.
I'm gonna rewind the clock a bit and go back to March when CITES had the MTC had its first, I think the first CITES call. That call, there were 75 persons on the call, 24 from 11 different states. Some states obviously were represented by more than one person. 5 of the 24 persons were from Indiana, 4 from Georgia, 3 each from Alabama and Missouri, where I was born. There were also 10 persons from the MTC on the call. 41 persons, if you're doing the math, were not from the states or from the MTC. 41 persons were mostly from advisor firms or from the press, who participated largely by eavesdropping. The 11 states that were on the March call are shown on this map here. You'll notice that there's substantial overlap between the 11 states shown on this map and the states that are commonly reported in the press as being the most active on transfer pricing matters. But there are a number of states who are really active on transfer pricing matters not on this map. You'll also notice a substantial overlap between the states on this map and the states that have separate reporting. And common intuition is correct, that it's the separate reporting states that have the most interest in transfer pricing. But transfer pricing is not of interest only to those states. And this is a point the FTA made in 2015, that states that don't have separate reporting, that have combined reporting, they also have an interest and a stake in transfer pricing. And you notice, for example, one of the most important transfer pricing cases at the state level in recent years is See's Candies out of Utah in 2018. Utah is not a separate reporting state, but it had a transfer pricing issue because in that case there was an affiliate that had been granted, that was holding the trademark rights to the See's Candies brand, and it licensed those marks out to its affiliates. Now, this IP holding company qualified as an insurance company, and under Utah law, as explained in footnote 4 of the Supreme Court's decision, insurance companies in Utah are taxed only on their premiums, not on the income they generate. So all of this trademark royalty income coming into this affiliate was sort of escaping taxation under the normal rules, which is what led Utah State Tax Commission to initiate this litigation.
And Matt, just to follow up on that, there are a number of bases on which companies can be excluded from a combined return despite otherwise satisfying the unitary principles. They might be an 80-20 company, and they're based abroad, and so transfer pricing disputes can arise for the reasons in See's Candy and for any of a variety of other reasons that entities might be excluded. We saw it wasn't a transfer pricing case, but there was a Pepsi decision out of the Illinois Independent Tax Tribunal just a couple of months ago, involved a foreign affiliate that Pepsi asserted was an 80-20 company, and Illinois Department of Revenue argued otherwise, and Department of Revenue succeeded. Had that been a transfer pricing issue, the same arguments presumably would have been made, and therefore that company would have been brought back into the combined return, or transfer pricing might have been affected. So it can come up in a variety of circumstances. Okay,
so there are a number of polling questions that were pushed out in the March MTC Citus call to gauge state interest on various questions. And one polling question was whether states consider it important to work together. And you can see the results of that polling question here. Now, obviously, the respondents are individuals, not states. So 17 respondents said it was extremely important. That could represent, everyone from 5 states, as I say, Indiana, Georgia, Alabama, Missouri, and one other. You just don't know how many states are represented by the various responses. But what's clear overall is that there was enthusiasm among the respondents for the idea of working together, which is not surprising, obviously, because it's a sort of a select group. These are the people who wanted to join the MTC Citus call in the first place. There was another polling question about how valuable it would be to exchange information with members of other states, and the results were very similar to the answers to the results of the first polling question, with a sort of an overwhelming response that it would be extremely valuable to exchange information among the states. at the federal level, you've seen a real change on this point over the years. When I was at the IRS from 2003 to 2008, the IRS was very reluctant to respond to information requests about taxpayers from foreign governments. It was slow. It was very selective. It often just sat on the requests. But over the last 10 or 12 years, that's really changed, and there's much greater exchange of information at the international level than was true just 15 years ago. So this, as David mentioned a moment ago, the MTC has circulated this revised information exchange agreement. They're trying to capitalize on the interest expressed among the states. There is already an exchange of information agreement that was developed, I think, 30 years ago, and I think about 24 states have already signed on to it. This is a revised one, which is substantially the same. It allows them to exchange information without going through the regular procedures. The call yesterday, David mentioned, it's July. So 7 states participated in the call yesterday. The ones shown here on this map in dark red are the states that also participated in the March call. The pink colored states participated in the March call, not in yesterday's call. The other 2 states, Arkansas and Mississippi, participated in yesterday's call, not in the March call. It's easy to infer too much from this. I mean, it's a phone call in July. This is not an indication of whether this multi-state transfer pricing initiative is going to take off. We won't know that. We won't know that for months or years to come. One thing that complicates a discussion about transfer pricing at the state level is that every state has its own statute, and the words of that statute differ, and the case law that's built up around those statutes differ. Some states expressly adopt the federal standard, the federal statute, Internal Revenue Code Section 482. I think that's Alabama, Arkansas, Maryland. Other states track the language very closely, although there's some deviations, and still other states sort of go off in their own direction, expressing many of the same principles, but in a different articulation of those principles. And the differences can be important. I mentioned on the call 4 weeks ago, I'll mention again, there was a case out of North Carolina in 2009 where the taxpayer argued that it should win, and it cited cases out of Georgia and Massachusetts for that principle. And the court in North Carolina said, well, those statutes are different from the statutes in North Carolina, so that case authority is really not relevant to you. You lose. So it's really important for taxpayers to speak to the law of the state at issue, because there's no easier way for a state to discredit the taxpayer's position than to assert that you've used the wrong standard, you've used the wrong terms. It's really important, I'll repeat it, that in the articulation of a taxpayer's position for any given state, that position be articulated and shown to be consistent with the precise words of that state statute. And the states don't always make it easy to know sort of what the words of the state statute mean. At the federal level, the IRS over the last 100 years has issued 130,000 words of guidance on Section 482. The same number of words as in The Tale of Two Cities by Dickens, 2/3 the number of words as in Moby Dick. So there's a lot of guidance out there. But that's not the case in the states. Some states have some respectable amounts of guidance. Some states don't really have anything at all. And again, there was a North Carolina case, this one, the Del Hayes case from 2011, in which the court went on at length about the lengths the state had gone not to provide guidance, not only to taxpayers, but not to provide guidance to the examiners themselves about what their state statute meant, what was acceptable, what was not acceptable. The court quoted the state official, and the quote is here on the slide, who said telling taxpayers what the rules meant, quote, would be like handing a gun to the guy that's about to rob us. So a company sometimes faces a bit of a hurdle in knowing what the standards are, but I'll return to my point. Whatever the standards are, you got to make sure you express your transfer pricing positions using the terms of the state statute. If states disagree with a taxpayer's position, they've got a lot of remedies available to them. Income and deduction adjustments are sort of the classic transfer pricing mechanisms at the federal level, and they are available to the states. But states have a lot of other remedies that they resort to more often. So forced combination is very common. You saw that in a couple of cases out of New York in the 1970s, the Campbell and Wurlitzer cases. You've got cases pending in court now in which the state is asserting forced combination. It's also common for states to attack transfer pricing issues by arguing that the transaction lacked economic substance or that the entity was a sham. Some transfer pricing cases, states argue that there need to be adjustments to or deviations from the apportionment formula, or they rely on add-back provisions in their statutes. About more than 20 states have specific add-back provisions in their statutes, and those are commonly used. Almost all transfer pricing cases at the state level, I use transfer pricing sort of broadly, almost all transfer pricing cases at the state level have gone to court where the states are arguing to combine returns or to disregard transactions because of lack of economic substance or sham, or however it's phrased. The impact of the state position is to force the inclusion of income or the disallowance of a deduction in its entirety. It's really different at the federal level. At the federal level, the IRS calibrates the transfer pricing positions. It's not all or nothing. It's not all your deductions are disallowed. All this income, all this pool of income has to be included. It's you sold this widget for $5. We think it should have been sold for $6. You earned a profit of 3%. We think it should have been 4%. And you may think that's nickel and diming things, but given the volume of transactions that are subject to transfer pricing scrutiny, that's real money. I mean, I mentioned the CocaCola case. They were adjusting the amount of the trademark royalty, not eliminating the trademark royalty, just adjusting its amount. And it added up to $12 billion, or could add up to $12 billion in tax and interest alone. More than 40% of all U.S. imports and exports are between related parties, involving trillions of dollars just in tangible goods every year. You adjust the returns on those by a few percentage points, and you're talking real money. And I think similar percentages apply at the states. If you look at cross-border state trade, you're talking about a lot of money. And so, as you know, states don't have a perfect track record in litigation in sustaining their adjustments. They lose as many as they win. I would expect that states are going to make greater recourse to the flexibility sort of calibration, either as their primary position or at least as a backstop to their sort of historically preferred all or nothing approach. In some ways, what we see from the states right now is very much what you saw at the federal level 100 years ago. It was 100 years ago that the Revenue Acts of 1918 and 1921 that Congress first provided the IRS with a tool to combat transfer pricing shenanigans. And that tool was forced combinations. The IRS was empowered to force combination of taxpayer returns, quote, in any proper case for the purpose of making an accurate distribution of income. It was in 1928 that Congress rewrote the statute to provide the IRS sort of with more tools to calibrate, to address, give it more flexibility in how it addressed transfer pricing. And as I say, over time, that's the path that the IRS has taken. So this brings us to our third polling question. Question, I have experience, or statement, I have experience where a state tax authority made a partial adjustment to achieve an arm's length result, rather than simply adding an item of income or denying an item of expense in full. 3 answers, yes, no, and I think I'd see it if it were happening, or no, but I'm not in a position to know. I'll give you 30 seconds. And the results are, all right. Well, this is interesting to me. 23% have seen it, and 66%. Is that math right? 76% have not. But nearly half people don't draw any conclusion from that because they're not in a position to know. But still, this is interesting. All right, so 100 years ago, the federal system was a lot like the state, what we're seeing in the states now in another respect as well. Because 100 years ago, the IRS argued that it basically had plenary unreviewable discretion to force combinations or to refuse to force combinations. Because at that time, taxpayers were actually allowed to request combinations, and the IRS had discretion whether to grant that request or not. And the IRS took a pretty muscled approach or view of its own authority as being almost beyond review by the courts. And you see states arguing that now, arguing that they likewise have broad plenary authority to make adjustments. And you have a quote from the C. Candy's case, Utah 2018, which reflects this state tax authority attitude. But courts have pushed back, insisting on some standard, resisting the notion that tax authorities have unlimited or unbridled discretion in the area. Again, you saw that in the Carpenter Technology case in Connecticut in 2000. You saw that again in the C. Candy's case, to which I referred. So this puts, and what they often do is say, well, this even though the state has no guidance, the state's statute is awfully similar to the federal statute, and there's guidance built around the federal statute. We're going to import that into state law to provide some sort of boundaries over the exercise of authority by the state tax authority. Even though federal guidance may guide the state analysis, it doesn't necessarily control it. So, for example, some states recognize that state tax authorities may be able to force combination or undertake other actions on transfer pricing enforcement, even though the taxpayer complied with the federal standard, the arm's length standard under the federal guidance. Even though the taxpayer complied with the federal standard and the state language is similar to the federal standard, some courts have allowed state tax authorities to apply action, take action to remedy what they perceive as the failure of the taxpayer to clearly reflect its income. Other states have said no. If the taxpayer has complied with the federal standard, basically all adjustments are off the table. The state tax authority cannot make an adjustment in those circumstances. And there's some authorities on this slide that give you a flavor for that. All right, so no matter what the standard is, whether it's governed by the arm's length standard at the federal level or whether it's applied, governed by a more tailored or idiosyncratic standard at the state level, it's clear from the court cases and it's clear from taxpayer experience at the state level that good documentation is important. And this brings us to a discussion of transfer pricing, dispute avoidance management, and resolution. We'll talk in a moment about what types of issues at the state level get the most attention, the specific issues, but let's wait for that for a moment. The best strategy for dispute avoidance, management, and resolution is good documentation. And there are two things that the documentation needs to achieve, and there are two types of documentation to achieve it. The first thing, and perhaps the most important thing given the climate in the states now, that documentation needs to achieve, it needs to show business purpose and economic substance. The second thing it needs to achieve is to show that the price is right. The two types of documentation, one type of documentation is outward looking, where the tax authority is your audience, and the other type of documentation is more inward looking. And I'll explain that in a moment. I mentioned that nearly all the tax authority enforcement in this area involves all or nothing adjustments, many of which are premised on the lack of economic substance, the lack of business purpose, that the entity was a sham. So there needs to be documentation that addresses this proactively. Now, the documentation should explain why structures were put in place, why the transactions are occurring and such. The best documentation is not a memo to file that says, this is our business purpose. That's useful. I mean, you should have that. But the more effective type of documentation isn't a memo that says this has substance, but a documentation that shows that the structure has substance. And I've seen some companies do what I call program manuals that serve as a kind of desk reference with respect to a company's particular operations. So, for example, let's take a trademark licensing program. The program manual may be 20 or 50 pages. It'll explain the origin of the program, its rationale, and its operations. It'll explain what marks are being licensed, who's required to get a license, how the royalties are calculated, how they're billed, how they're collected, who manages the program, who to go to if you have questions about the program. It's basically a Bible, or as I say, like a desk reference that has everything you need to know about this program. So if one person who's been assigned the responsibility of running the program gets hit by a bus, you can turn over this notebook and another person can take over the program, understand exactly how it works, why it works the way it does, what the exceptions are, and hit the ground running. And the real, well, not the purpose. It serves multiple purposes. One, as I say, is to store institutional knowledge, but another thing is to put in the sort of the best, most persuasive way for a tax authority to understand what's really going on here. It's a very effective tool in terms of sort of persuasion. So that's one type of documentation that addresses economic substance and business purposes. And then you have the sort of traditional standard transfer pricing documentation. And these have become very common, particularly at the international level, because many countries actually require them and impose penalties if a taxpayer has not prepared them on a timely basis and does not turn them over upon request. And the penalties associated with the absence of this documentation are ridiculous. I've written one letter to the editor in my life. It was earlier this year in January, and it was about just how ridiculous the transfer pricing documentation penalty regimes are for failure to maintain proper documentation. And these penalties apply even if you got the transfer pricing right. I mean, your transaction has business purpose, it was priced right, you've collected it right, you've reported it right, but the mere absence of the supporting documentation will subject these companies to big penalties, which just strikes me as a complete failure of priorities. But so there's a whole industry built around generating these reports for taxpayers. And the reports are 20 to 50 pages of text, often accompanied by hundreds of pages of exhibits. They talk about, what the transaction is, who the parties to the transaction are, what the roles and responsibilities are, how the price was set, and the rationale and the support, the external economic support for the price. The other category of documents that are, as are the intercompany agreements and the internal documents. So, for example, if you have a trademark royalty program, do you have licenses? Are they written out? Are they signed? Are they still in effect? Are you abiding by them? If you have intercompany loans, do you have loan agreements? Are the agreements signed? Are they still in effect? Are you abiding by them? It's very often the case, and this is really bad, that taxpayers think they have the documentation in place, but when push comes to shove and they have to produce it, they realize it's not. They either don't have it, it wasn't signed, it's out of date, or it doesn't quite say what people thought it would say. So controllership around documentation is really important. I've seen hundreds, probably thousands of transfer pricing studies. Some are good, some are adequate, some aspire to be adequate. The length of them bears little relation to their quality. There's some clear lessons to be drawn from the good ones. The slide doesn't mention it because it should go without saying. They ought to be written clearly with a minimum of jargon. I've had lots of experiences where I get this jargon-laden documentation, and I ask the person who wrote it, what does this mean? And they say, I don't know what it means, but these are the words that everyone uses, so I figured they belonged in the report. That's something to be avoided. The point on this slide about being thoughtful and nimble in anticipating change is to realize that when you prepare a report, you have to look beyond today's imperative. It's not enough to support your position today. You have to understand, as you know, businesses change in unpredictable ways, and you want to make sure that your reports are written today in a way that not only serves today's needs, but positions you for success in the future. Taxpayers will seize on any statement in a report and use that against you in the future if it's to their advantage. One of the areas where I see real deficiencies in transfer pricing documentation is in their discussion of who makes decisions or who bears risks. Very often, these expressions are really flat-footed and categorical, and that's a mistake. The documentation needs to reflect reality, and reality is often complex and subtle, and your documentation needs to acknowledge that complexity, that subtlety, so that you're not caught flat-footed the next year by some statement in prior documentation that's being taken and exploited against you. I've got lots of examples, but less time to go into them. So one of the things that's important to do is to avoid this. Don't paint yourself into a corner. I will give you one bit of advice. Everyone talks about limited risk distributors. Almost all documentation, if you've got a low-risk distributor, will use that term. This is a limited-risk distributor. I don't use that term, and I recommend that no one does. Just say what the risks are. Leave the characterization for when the issue has been identified and you're sitting across from the examiner and talking about the facts. But loading up your transfer pricing documentation with characterizations, I've never seen that work to someone's advantage. There are other things you can do in your transfer pricing documentation to help yourself try to sort of define the transfer pricing discussion or shape the discussion. In most cases, a tax authority will come in and they'll say, we're only focusing on this transaction for this time period. But there are things you can do in your intercompany agreements and in your documentation that can help force a broader perspective, tie transactions together, and make it more difficult for tax authorities to cherry pick or take things in isolation either with respect to the definition of the transaction or the time period involved. You can also take steps through your selection of the transfer pricing method and your choice of comparables to achieve sort of similar beneficial effects. Which brings us to our fourth polling question. I think having transfer pricing studies available for state tax purposes is, 1, not necessary, 2, a nice to have, but a bit of a luxury, 3, a good use of company resources, 4, important. And the answers are okay. Speaks for itself. In terms of the issues that get the focus at the state level, I'll say it for the 4th time. If you've got an IP holding company, particularly a trademark holding company, you are in the bullseye. That is the single most common scenario in which state transfer pricing examinations seem to occur. You've got 3 cases on the screen. There are lots of other cases. There's the TJX case and the Sims cases, both out of Massachusetts in 2009 and 2002. You've got the CocaCola case I mentioned at the federal level. There was a recent article written in which an advisor to the MTC identified trademark royalties as an issue. I don't recall if he said the issue, but an issue for state transfer pricing enforcement. Intercompany loans, very much in the area of scrutiny. In any financial transaction, loans, you've got a couple cases cited here, the DuPont case and the Carpenter Technology cases, but you can come up with other cases as well. It's an easy issue to examine and adjust if appropriate. And then, of course, there's the sale of release of goods. You had just a couple of weeks ago a case out of New Jersey in which the New Jersey Tax Authority examined the leases, the price on leases for aircraft, for use of aircraft related party, and argued that the New Jersey licensor was charging too little for the use of the aircraft and proposed to disallow multiple years of NOLs on that basis. And then management services. Management services is one of those areas in which you may not think you even have a service, a transaction to charge. A tax authority may think otherwise. So if you've got a headquarters that performs a lot of functions and is taking a lot of deductions on its return, the tax authority in that jurisdiction may be saying, well, these functions you're performing are a valuable service to your affiliates. You ought to be charging them out and collecting income from them. And that's a common situation in which the tax authority perceives a transaction that the taxpayer did not, ripe for adjustment. Coupling one of the common areas for adjustment with the needs for documentation, here are the 4 most common intercompany loan transactions. Is it debt or equity? Even if it's debt, is it an arm's length amount of debt? Is the interest rate set right? Particularly, did the borrower's credit rating give enough weight and potential uplift to considerations of its affiliation within the controlled group? And lastly, what are the prepayment options? Was the interest rate, if you're allowed to prepay the loan and refinance, then the tax authority is going to look to see what happened to interest rates between the time that the interest rate was set and the current period. And if the interest rates ever decline, the tax authority will say, well, at arm's length, you would have refinanced that loan at the lower rate. Therefore, we're going to disallow the delta in interest deductions. So you want transfer pricing documentation that's thoughtful and that addresses these issues proactively. Examinations, expect internet searches. That's just obvious. But what may not be obvious is that the internet searches may look at LinkedIn profiles of your employees. Expect interviews. Prepare your witnesses. There are 3 things you need to tell a witness. Be truthful, be forthcoming, don't be evasive, don't be argumentative. All those were in the sphere of be truthful. The second thing you need to tell them is don't speculate. Don't try to be helpful by answering questions that require you to fill in gaps of your knowledge. If you're going to say something with the phrase "I understand," don't say it. Just say what you know. Stick to the facts. It'll take you weeks or months and lots of money to chase down a statement that some employee made where they were speculating, and you need to go and convince the tax authority that that's not, in fact, true. That's a real problem. And enlist your business experts, because the people with 20 or 30 years of experience speak with authority, and it's really hard for a tax administration to contradict them. In the last minute, transfer pricing, advanced pricing agreements, if you got caught up in litigation, you're going to be in litigation for a long time. State transfer pricing matters proceed at about the same pace as federal ones, which is to say, takes a long time. Of the 6 recent cases, 12 years elapsed between the most recent return filed and the court decision. So there are advanced pricing agreement opportunities. Indiana launched the first one at the state level, the first formal one at the state level last year. But other states make them available on an informal basis, particularly in the exam or audit context, where you reach an agreement and they allow you to have it apply with prospective effect for a number of years. It's really a useful tool. States have shown that they are, or have said that they're receptive to making them available. This was a question from the March CITUS call, in which the respondents said we either have them. Those 4 respondents were obviously all from Indiana, or said we're interested in them. And so this is a mechanism that you ought to keep in mind and maybe discuss with the tax authority. Let's go to our last poll question, which brings us to our conclusion. 5 years from now, crystal ball. I expect the level of transfer pricing enforcement at the state level to be lower than today, about the same, a bit higher, or significantly higher. 30 seconds to answer. And a majority, not just a plurality, a majority say significantly higher. I think there's a good likelihood of that. So I didn't get to any of your questions. Apologies. We've run out of time. My contact information is on these slides. You can find me on the internet, mfrank@steptoe.com. I'm happy to answer your questions. I'm just sorry that I didn't leave enough time in this session to do that. David, to you.
Well, Matt, well done. Thank you very much. And I can only echo what you said, which is that people should contact you with transfer pricing questions. Feel free to tee those up. There are a number of responses if transfer pricing becomes an issue. And the studies that you mentioned are one, and the usual responses to advanced to anti-passive investment company situations that we've experienced over the years are the others. So we have a number of tools at our disposal, but your transfer pricing skills are going to lead the lists if these become involved. I want to thank you. Thank everybody for joining us. I think that covers it. Do we have any concluding announcements? Katie, anybody else?
Not for me, no.
Okay, well, thank you all, and we will send out the CPE and CLE certificates in short order. All the best. Bye for now.